Good morning. Our topic is all about the role of the central bank. How should monetary policy be conducted? So, this topic is composed of two parts. First, I'll be talking about monetary policy, and my partner will be talking about central banking. Learning objectives. At the end of the discussion, one should be able to define monetary policy, describe the general role of a central bank, differentiate clearly expansionary monetary policy from contractionary monetary policy, and apply the categories of monetary policy to the tools used for its implementation. So, what is monetary policy? In the simplest definition that I can have, monetary policy is an action done to control money supply and achieve macroeconomic goals that promote a sustainable economic growth. Also, it includes financial institution regulations. Okay, so basically in here, monetary policy has the power to control the amount of money supply, so meaning this is the money in circulation, in the market, and it also seeks to achieve macroeconomic goals. So what are these macroeconomic goals? So these are the topics that were discussed earlier that talks about the GDP, inflation, unemployment. Okay, so with the use of monetary policy, it somehow promotes the increase of GDP, maybe balance inflation rates, and to the extent increase employment. So meaning there will be more citizens that are employed. With that alone, money can freely circulate within the market. Okay, so who is the one that controls this one? So it's the role of the central bank. So what is a central bank? A central bank is actually the authority who could print money. Okay, print money. So they are the ones that creates money. They are also the ones that regulates all of these macroeconomic goals and the money supply that is being circulated in the market. So in the Philippines, the central bank that we have is what we call yung Bangko Sentral ng Pilipinas. In the United States, it's what they call the Federal Reserve Bank. So these institutions are the ones that control or implement monetary policies. So monetary policies consist of what? So there are several components of monetary policies, or rather I call it objectives of monetary policy. So first and foremost, as mentioned earlier, the money in circulation. Okay, so whenever there is few money circulating within the market, with the use of monetary policies being controlled by the central bank, they try to infuse money in the market so that the supply of money increases supply of money. And whenever there is too much money, they tend to take away money in order to decrease the supply of money. Okay, what's the risk? Why is it that there's a need to take away money from the market? It's due to the fact that if there's increased money in circulation, there's too much money circulating in the market, there will be a tendency that it will increase inflation. Okay, so inflation rate increases. This is because if there's too much of something that is being circulated, the value of that something somehow decreases. So the central bank needs to prevent that in order for the inflation rate to go down. Next component or objective, interest rates. Okay, so what are interest rates? So basically, these are additional increases in or decreases in your money whenever you borrow from a bank. So what they do is, in order for to regulate borrowing, they tend to manipulate or change the interest rate. So if there is inflation, meaning too much money is circulating, what they tend to do is they increase the interest rate so that people will encourage to deposit money or prevent people from spending. So by manipulating the interest rates, by either increasing it or decreasing it, it regulates the amount of money being circulated. Thirdly, okay, as I have mentioned before, inflation. Okay, inflation. Inflation is a big component of monetary policy, because if inflation rate really is too high, then all the goods and services that are being sold in the market is also very expensive. So tendency is, I have read this from an article several years ago that I think this was a country from Africa. I couldn't remember, that whenever they wanted to buy bread because of the inflation rate is too high, they really need to carry a wagon full of money in order just to buy a single piece of bread. So I don't know if I cannot visualize that happening in the Philippines. So if you want to buy money in Julie's Bake Shop, then you need to carry an entire wagon of money just to buy some. Okay, so with the use of monetary policy, inflation rate is being checked. Okay, so there are two categories of monetary policy. So basically, there are two broad categories of monetary policy. The first is expansionary monetary policy. So when does this happen? So it happens during high unemployment rate. So I want you to take note of these keywords: high unemployment rate. Okay, so high unemployment rate. What does this mean? Does this mean that many people are working? Many people getting too much job if there's high unemployment? Obviously not. So if this happens, people are not working, people are unemployed, people don't have jobs, the market the market tends to lose money, right? There's no money circulating. Why? Will businesses open job vacancies, or will they be hiring employees? Obviously not, because they have nothing to pay for those employees. Now, with the use of this monetary policy, specifically your expansionary monetary policy, they tend to infuse, okay, from the word, okay, so infuse money. This comes from the word expand, okay, you spread, okay. In here, the central bank, the authority that regulates money, they tend to spread money to the market. Why is this? This is because there is low money circulating, so they try to help the market by simply releasing money from their reserves. So how do they do this one? Okay, they do this one, example is through loans. Okay, through loans or buying government bonds. What are these government bonds? Simply speaking, government bonds are like loans. Okay, they're somehow the same. So if the central bank wishes to infuse money to the market, they just simply have to offer loans. Okay, offer loans at low interest rates. This encourages the businesses or the government to borrow money from them. In turn, they will use that money to create projects. For example, if they buy government bonds, the money there will be used for projects like road repairs, right? Road repairs. So in order for the road to be repaired, obviously they will hire contractors, they will hire construction workers in order to really fix roads. So with that alone, it contributes to employment, right? there will be increased employment. Okay? This is just one example of how employment rate increases. So if there are more opportunities for people to work, then that's a form of expansionary monetary policy. Okay, now how about the interest rates? Interest rates here. If we talk about the interest rates, will it be increased or will it decrease in terms of expansionary monetary policy? Remember that in here, the central bank infuses money. So if it gives off money to the public, to the general public, it encourages spending, right? If spending is encouraged, what happens? Too much money will be circulating. Okay, so will people tend to deposit their monies in the bank, or will people tend to get money from the bank? Because I believe most of the people's reason is that they reason for depositing money is simply to have that money grow through interest, right? So in this case, they will lower down interest rates in expansionary monetary policy. This is again to encourage spending, promote spending, so that money will be circulating. Okay, I hope you are getting the point here of expansionary monetary policy. Increases spending. It also helps in increasing the employment because there's a lot of money that is to be spent. Okay, hold on. Okay, so that is for that's for expansionary monetary policy. The second component or the second category of monetary policy is what we call the contractionary monetary policy. Okay, from the word contract, what does it mean? It shortens to shorten rather. Hold on. To shorten. So if there's shortening, it limits, right? Inhibits. It inhibits money spending. This is the opposite of expansionary monetary policy. So in here, when does this happen? Contractionary monetary policy happens if there is increased money supply, meaning there's too much money already being circulated. So maybe this will be the end result of expansionary monetary policy, where it encourages too much spending, then money supply increases in the market. Okay, so with that alone, if you have increased money in the market, then if you have increased money, if there's increased money in the market, if there's increased supply of money to be specific, it increases the inflation. Again, definition of inflation, there's increased money supply. If there's increased money supply, there will be decreased value for money. Okay, my analogy for this one is an example for this one, in order for you to grasp the concept, is rocks and diamonds, which between the two is easily located, meaning there's a lot of supply anywhere in the world, right? So you have rocks. So do you think rocks are more valuable than diamonds? Obviously not. So if you have increased supply of rocks, obviously they are not highly sought after. Okay, so it has low value. In contrast to things that are very rare to find, you cannot easily find diamonds in your backyard unless of course it's a diamond factory, then it increases the value. It has a high value. Okay, so what do I mean by this one? So if money is too scarce to find, or it's too scarce to find in the market, then its value is increased. Tendency is depositors or the general public will put it in the bank, and in opposite, if it has low interest rates, then they will remove money from the bank in an attempt to increase spending. So This simply means that contractionary monetary policy is just the opposite of expansionary. So in here, in contractionary, again, let us analyze. Will it increase interest rates, or will it decrease interest rates? As mentioned earlier, in here, you have decreased interest rates, right? So in here, it's just the opposite. It has increased interest rate. Why? This is a strategy wherein the depositors or the general public, again as mentioned, since there is increased interest rates, they tend to limit the spending, inhibit their spending activity, and put it in the bank because of interest rates. In addition to that, businesses will also not be borrowing from the money. So instead of infusing money in contractionary monetary policy, what happens there? They are taking away money from the general public or the market. So these are the two things, or the two categories of monetary policy. Next, there are also tools being used by the central bank in order to implement the monetary policy. First tool is what we call the open market operations, or OMO. So OMO simply means that, as mentioned again earlier, buying of bonds. Okay, so this is for the government bonds. So if they buy government bonds, then it's a form of OMO, or open market operations. Other thing is that if buying and selling assets, this is actually done by your central government as usual, and this is termed as your quantitative easing, or QE. So where will this belong? Is it belonging to expansionary or contractionary? So I think it belongs to both of those categories of monetary policy. If the central government buys things, especially assets, which is in form of real estate, usually real estate, if they buy things, what do? Are they infusing money to the market, or are they taking away money from the market? Obviously, if they buy, they release money, so they're infusing money to the market. So if there's infusion of money in the market, it's termed as, expansionary. If they sell, are they infusing, or are they taking away money? Obviously, it's contractionary, because they're taking away money by okay, so let's now go to the next tool. Next tool is that if the central government performs its role as the lender of last resort. So what do you mean by a lender of last resort? So this simply means that if instances where financial institutions are struggling financially, they're really going bankrupt, there's a tendency wherein the central government will help them with their struggles by simply loaning money, allowing loans for them with low interest rates. So they simply change the interest rates in order for these financial institutions to borrow money from them, and that's termed as your discount rate. Okay, and or simply requiring collaterals as well. So collateral, this is something like an asset from the borrower. This is actually an assurance that whenever they cannot really pay off the loan that they got from the bank, then the asset will be used by the financial institution or the central bank to sell in order to cover up the losses by that particular loan. Okay, so that's the second tool. The third tool is what we call the reserve requirements. Okay, so reserve requirements are the amount of cash in banks that usually they must have in their vaults. Why is this important? Because reserve requirements will determine if the bank are allowed to let other financial institutions to borrow from them, or other businesses to borrow from them. If they have lower reserve requirements, obviously they are not allowed to borrow because their bank, that financial institution will go bankrupt if they have no reserves in their money. In opposite as well, if they have so much reserve requirements, then they're allowed to infuse money to the market. And lastly, this is a less conventional way of, or a less conventional tool, because the first three, these are the three things that, or the three tools used for implementing monetary policy. And then the last one is an unconventional method wherein they used as one. The three tools are combined into one tool, and it's not usually used. And that's it for my topic. And I'll now give the floor to the next reporter.